Hey Jeff, how are you?
Hey Nancy, how are you?
I'm
Is
good.
that are you in your kitchen?
No, actually, but it does look there. There is a kitchen here. It's a cottage, so it's a one-room cottage, and it has a sink and maybe a microwave if you're lucky. But it's also an office. Um,
Excellent. I thought we might be doing a cooking webinar, so I was a bit confused, but it looks beautiful. So
so I'll be
great,
honest, if
great to
you're
you.
doing a cooking webinar, I am really ill-equipped for that. Not my strong suit. Um, so but thanks. It's great to have you. And I want to thank Jeff Dorman very much and IREI for helping to organize the webinar today. Jeff Dorman's been just an incredible friend to the real estate industry, and IREI is a source of reliable information, meaningful networking. And in fact, it's due to IREI that you and I met, Jeff, some 20 years ago at a conference.
20 years ago, that would make us sort of old, Nancy. I don't think that's possible, but I do remember that when we met at one of Jeff's conferences a long time ago. And as I recall, I've been trying to get you to help raise capital for our funds ever since, but to no avail. So, but at least we get to do a webinar together. You've got a great practice, and maybe someday we could be a client.
Jeff, you're doing just fine from what I hear. You've invested a few $billions over the last several years, and you've got a great platform at StepStone. But as you actually taught me, you were the first person who explained many years ago what a secondary is, and went on from secondaries to recaps, and done a great job in I don't know anyone who knows more about recaps than you. So I really appreciate your taking the time to talk with us today.
Yeah, my pleasure.
Maybe you can give us a sense, of what the platform that the StepStone platform looks like today. I know you invest capital both on a discretionary and a non-discretionary basis, and you have an advisory practice as well, offices in the US and Europe and Asia. Maybe just give a little synopsis of kind of what the platform looks like.
Yeah, starting off with StepStone broadly, StepStone's a global private markets firm, and besides real estate, we have significant practices in private equity, infrastructure, and private debt. The real estate business, as you suggested, is a hybrid asset manager and advisor. So we have about $106 billion of assets under advisement, and that's a lot of that's capital we oversee for clients. And about $6-7 billion is discretionary capital through our funds and separate accounts. And the discretionary piece is really focused on secondaries and co-investments. So we really do three things in StepStone Real Estate: primary investments in funds, largely on behalf of clients through advisory models; secondaries and co-investments; and recapitalizations, in our view, in our world, are largely related to secondaries. So we put recaps in the secondaries bucket.
Got it. Well, maybe that's a good place to start, because we're obviously here to talk about recaps. The first question, we have a business at Park Madison where we focus on recaps, and oftentimes the first question people ask us is, well, what do you mean by recaps? So the lexicon can be confusing. People often use different words to mean different things. High level, when we talk about secondaries, we're talking about acquiring interest from existing investors. So generally, a secondary just provides liquidity to the investor or the LP, but not necessarily to the GP. And it doesn't involve restructuring the vehicle. And recaps are a little more complicated, sometimes a lot more complicated. They usually involve some element of restructuring the vehicle. It could be a fresh injection of equity, it could be pref equity, it could be common into an existing vehicle, or maybe setting up a new vehicle where the manager stays on, but the investors or the LPs exit. Is that how you think about it, or do you want to add anything to that?
I think mostly with maybe a couple different nuances. First of all, I think we add a third definition. You said secondaries and recaps. We focus on what we've termed special situations secondaries. And, and just to help with definitions, contrasted to a traditional secondaries. A traditional secondary is one that people typically think of where you buy a passive, non-controlling interest from an LP, typically in a big name fund. So that's really a traditional secondary where you're becoming a replacement LP for an LP seeking liquidity in a traditional fund. But again, like any fund investment, you end up in a passive non-controlling interest. Also, when you're buying those positions, because you're buying them from an LP who really depends on quarterly reports for their information and the manager doesn't have a lot of incentive to help you with diligence, the amount of diligence you can do at the asset level is pretty restricted. Special situation secondaries, which are where you're investing in an LP position or LP positions really with the support of the manager. Some people call these GP-led secondaries, but really with the support of the manager, so that you're able to do substantial due diligence at the asset level as if you're buying the assets. And we typically need to restructure the vehicle to gain some level of control as well. So to your point, you had said recaps are generally where restructures are involved and secondaries aren't. Many, or I'd say most of our secondaries or special situation secondaries do involve some kind of restructuring of the vehicle for control. And so the only other nuance I would add is we don't see secondaries and recaps always as being distinct. A substantial number of our transactions involve both. For example, we may buy out the entire LP base in a vehicle, and that would be a secondary. And at the same time, provide additional capital to the GP or manager to help them create opportunities or solve issues in their platform, and that's a recap. So a lot of our investments have secondary and recap elements to them, so they're not really mutually exclusive.
Okay, great. Well, we tried to shed some light on the lexicon for those of you who are listening who have been a little confused about it. I'm sort of reminded of my favorite hobby, which is gardening, and a rose by any other name would smell as sweet. A rose by any other name would smell as sweet. So these are all ways of taking liquidity on the one hand, and funds or real estate operators who have portfolios, and creating some liquidity for them. And there's lots of different reasons for it. So I think over the next 15 or 20 minutes, what we'd like to do is dig into some of the reasons, some of the situations, Jeff, that you found yourself in, deals that you've done, problems that you've solved, risk points. And as we're going through, I just want to mention to everybody, there is a little Q&A function on the bottom of the screen, or there should be. Feel free to input questions there. We'll have somebody fielding them, and we'll leave the last 15 minutes or so to answer your questions. So one of the things that we're often asked is, are recaps something that just happened in distressed market cycles, or do you see them in stable as well as distressed times? And so, the answer is certainly they can occur in both stable and distressed times. Real estate doesn't need a distressed market to find distress, as we well know, but also sometimes there's just a mismatch. So a real estate asset may take longer, for example, for its own life cycle than the 7 or 8 year fund structure that it finds itself in. So funds at the end of their life, where there's still real estate opportunity, often are in need of new capital. The fund needs to wind up. The real estate needs to carry on. The manager wants to continue on with those assets. We kind of think of those as fund windups. Jeff, do you want to talk a little bit about how those work for you, and maybe any examples of situations you found yourself solving there?
Sure, Nancy. I think first of all, you hit the nail on the head, that recaps or special situation secondaries are valuable to LPs and GPs in every phase of the market cycle. And so if you take a more stable market cycle like we're just coming out of, we were focused quite a bit on, as you suggested, helping funds wind up. There's a number of situations where the GP feels that it'd be valuable to continue to own and add value to the assets, and the LPs are looking for liquidity. So we've been helpful to LPs and GPs by buying out the LP interests, sometimes adding additional capital to those vehicles to continue the funds beyond their legal terms. So, and really there's two really disparate catalysts for these types of transactions. One would be where the fund has performed, poorly for, any one of a number of reasons, and the LPs are really just looking to sort of cut their losses and leave and redeploy their capital. So they may be willing to sell to a buyer like us at an attractive discount, or a reasonable discount, so that they can just, exit the situation. And the other is where they've been long-dated investors. They've been in these vehicles for a long time. Either if it's a fund, it could be throughout the fund term, or sometimes, in the non-fund world, where they may have been investors for a decade or multiple decades, and they've made such strong multiples and returns that they can benefit from a very efficient, immediate solution, where we can get in at the right kind of discounts, and they can still have achieved a great long-term return. So really two ends of the spectrum. One where managers have, where a fund has not done well, so the LPs are willing to sell out and exit the fund, and one where they have done well. So you'd ask for an example. So we invested in a fund windup. We call it Project Curator, during the more mature phase of the market cycle. The manager, unfortunately, had raised their capital in 2006, so it's a 2006 vintage fund. Not a great time to have raised a lot of capital and being forced to deploy a lot of capital. And this was a manager who had converted from an operator, and it was their first time fund, and they'd been lucky enough to get in some really strong foundation and endowments into their investor pool. But when the market collapsed in 2008, 2009, and they were about 75% average leverage on their assets, their value diminished from, it was a $100 million fund. They deployed $90 million of it, and their value had diminished to around $40 million or so on a mark-to-market basis, which, the math is pretty easy. If you think about a 75% levered fund, the GAV doesn't have to drop that much to get you there. But frankly, they were at the end of their fund life now, and they are wanted to continue. They thought there was value still to add to the assets. They hadn't been able to do the leasing that they thought they could do because they were liquidity constrained. The LPs weren't going to give them any more capital because they didn't believe in them. And the LPs asked them to sell the assets. So we worked with them on a different solution where we would buy the LPs' interests out and then provide the additional capital for tenant improvements and CapEx so they could get the properties leased and sold. It turned out to be a win-win because the LPs, although they did sell at a discount to the marked value, it was an instant liquidity solution for them to exit a manager that they weren't going to continue with. The manager was able to reset. We allowed the manager to reset their basis so they could earn then carry off of our investment on those assets, and clearly they were out of the carry before. And we benefited from, we thought, an attractive deal. We exited. We ended up over the course of the next couple of years selling off all 10 assets and achieving about a 25 IRR, which was right about our target for the deal. So we really consider that a win-win-win.
Well, it sounds like it was certainly a good deal for you. One of the things we hear a lot from investors or limited partner, from GPs and LPs, is how do you get comfortable, or how does the GP get comfortable as a fiduciary that it's the fair thing to do for the investors to sell to you rather than just try to sell the assets outright? And how do you get the investors, how do they feel good, or why should they feel good that this was the right solution rather than just, going to the market and doing the best they could? Was
Yeah.
there a portfolio premium, or is that generally the situation, or timing premium, or is it all about communication and transparency, which is what a lot
I
of
think
folks.
it's I think it's about communication and transparency and about what different people's motivations are. In this case, look, I mean, one of the LPs who I know really well, whose interest we ended up buying out, sort of said, darn you and thank you at the same time, because, on the one hand, we bought their position out at a discount, crystallized a loss for them. On the other hand, we provided a liquidity solution, which allowed them to exit the position, redeploy their capital to something that they thought was a better use. But ultimately, it comes down to a negotiation between the GP and their limited partners. We stay out of it. It's not really our place to negotiate a fund windup with the LPs. We really stay out of it. We may either be offered a price that the GPs brought to us prepackaged. They've already negotiated with their LPs, or we'll give a price and then they go away sometimes for months to work with their LPs on whether or not that the pricing is acceptable. But look, I mean, GPs are typically stand-up, good fiduciaries, and they know that they're not going to be in business if they do things that are not in the best interest of their LP base. So it really does have to be a win-win. And frankly, we wouldn't partner with a manager that did the wrong thing by their LPs to do the right thing by us. I mean, that's not the kind of manager we'd want to be a long-term partner with. So
That makes sense. So let's think about a different situation, because I'm sure a lot of your situations are not traditional GP LP funds, but you might have an operator who has aggregated high net worth capital along the way to put a portfolio together, or what we call a fundless sponsor, someone who, when you and I started out in the business, would have been able to raise a fund, but because it's so hard today, they've kind of cobbled together capital. And now they may have many, many investors. They may want to consolidate their investor base, but also get to institutional capital, which will help them as a sponsor grow going forward. So when you look at transactions from sponsors who are looking to consolidate their investor base and who also want to use your relationship to scale and grow, can you give us an example of something you've done in that framework and what some of the issues and pitfalls are?
So, yeah, I mean, that's another really strong catalyst for recaps. We think from us largely. As I mentioned in the introduction, we have a substantial primary capital investment business. So we put out $13 billion into real estate funds on behalf of our clients, both on a discretionary and non-discretionary basis, last year. So it's interesting for managers to use us as a recap source because they get a chance to sort of audition for our primary capital. Certainly we would never allocate capital to anybody, any primary capital, somebody just because we get a recap or secondary with them. But it is a good chance for them to get to know us and get to audition for us as a potential source of primary beneficiary of primary capital, and that can either work for them or against them, frankly. So to answer your question more directly, there are a number of managers that seek our capital in a recap situation in order to grow their platform, and then potentially as a next phase, get allocated primary capital as they build their fund business. And I think one really good example is a investment we made in the UK, and it was in a care home platform. And care homes, just to help with definitions, are the UK's version of really a combination of skilled nursing and assisted living that we have in the US. And it works like in the US on both a government pay and a private pay basis. So we recapitalized the largest private pay provider, care home provider in the UK and they used the proceeds in order to buy out a portfolio from their biggest competitor. It was a hospital company that owned a care home, that had a care home division. And this company bought that hospital company's care home division and then became, it basically ensconced their place as the largest private care home provider in the UK. So we provided the capital for that transaction on a participating preferred basis. So it was a really good, we think, security for our investors. We came in a preferred position, so there was substantial equity subordinated to us to protect our investors' capital. There was a strong current pay feature, so we're able to pay our investors, an attractive quarterly dividend. And then the rest of our target return was achieved through an interest accrual feature. And we never felt at risk with that accrual piece because there was enough equity subordinate to really support that accrual. And then finally, we had a relatively small equity kicker, so that as the value of the company grew, we would benefit from the value increase. So, again, sort of a win-win-win. The manager was able to grow their platform. We were able to achieve great risk-adjusted returns for our investors, and and we could be a source of primary capital for this manager later, assuming that they perform well.
Right. No, that's so interesting. And when you're in so many different places in the capital stack, as you were, and your return is dependent upon current return, but also future growth, you sort of obviate some of the questions or back and forth about price, because there's hope notes, there's it looks a little bit different, and you've also created some probably some capital solutions for the owners in doing that they might have to price somewhere else. So it's a very interesting structure.
I mean, you hit the nail on the head, and that's really how we determined to get into this business in around 2010, when we were predominantly secondaries players. And as prices were dropping precipitously, intrinsic prices in real estate, but managers' marks weren't keeping up. And we had to, and we price everything from the ground up. So we were coming up with such substantial discounts for buying these secondaries based upon our DCFs that, and since managers hadn't marked down the discounts that we needed to buy at to protect our investors' equity and to get our target returns, which is an increase, were just too wide to ever expect there to be a trade. So what we did was we kind of turned the business on its head, and we said, look, we don't have to argue about pricing or talk about pricing if we recap the vehicle itself, the fund itself, bought through a debt or preferred equity security, because it's not about pricing, it's about our view of what the equity subordination is versus a manager's view. And you never have to get into insults about pricing. So that's really how we ended up initiating our program to do recaps, just through the exact example you gave of the bid-ask spread in secondaries.
Yeah, no, it's a very elegant solution. One of the things you've touched on, and I just want to clarify, because there are one of the things we've seen over the last several years is more and more funds or interest in buying opcos, or interest in operating companies, as well as the property or propcos. And when you talked about helping someone grow their business, in this particular care home group bought another company, did you actually invest in the business as well, or are you really focusing just on the real estate?
We're really focused on the real estate. We've done certain transactions that have been opco-propco deals combined, where the majority of the capitals really go into the properties, but it really goes into the opco-propco structure, and a significantly smaller portion of the return, and our capital is really going to the opco. So we're not really PE investors in that sense.
Yeah. So we're starting to see more of that, and I'm just laughing because given that we're then tasked with going to talk to the investor group and saying, would you be interested in investing? It doesn't easily fit into one bucket, i.e. the real estate bucket, if you're an opco-propco investor. it becomes more.
I'd add, I think it's a perfectly good business. I think it's really interesting to be investing in the opcos, and you get enhanced returns off from your share of carries and fees. I think the questions are liquidity. How do you exit an opco? I think it's a great business. It's just less a focus of our recap program.
Right. I agree. I think it's a great business too. So you touched on, we should talk about distressed market situations. I think you recently wrote an article, and maybe if I'll get this right, when bad balance sheets happen to good managers, and it was kind of looking at COVID and GFC and, where we might be. Did I butcher that, or did I get that right, more or less?
Yeah, you got it pretty right. I would have butchered it more.
But, clearly in distress situations, you've got all kinds of funds and structures that, where you have a broken capital structure, you need rescue capital, you have covenant breaches, you need to pay down debt, you have to extend maturities. And obviously we saw lots of this in the GFC. We are starting to see it, certainly it's in the press these days about the hotel sector. And so how are you seeing this part of the business, and kind of where do you see, or maybe the opportunities over the near term for distressed recaps?
It was your lead in was important. Yeah, in 2010, I wrote an article called "When Bad Balance Sheets Happen to Good Managers," talking about the whole need for recapitalizations in the market following the GFCs, because a lot of great managers just found themselves with big liquidity problems, principally as their values changed, or the recession affected their P&Ls, and they got into trouble with their lenders. So our business was really structured to help recapitalize those entities. And then more recently, I think in the June issue of Institutional Real Estate letter, which was I actually just dusted off that article and wrote and updated it and called "When Bad Balance Sheets Happen to Good Manager, Redo," because I am fully expecting the dynamics that ensued after the global financial crisis during the GFC and recovery period to present themselves in the pandemic downturn and recovery period. I think the factors are going to be much the same, and we're going to see deals driven by the same fundamentals and dynamics. So that's kind of history rhyming, if you will. And so to answer your question by way of example, I think you had. You said, what's an example of a deal you had done where all of this restructuring is necessary? So this is a GFC era investment we made, very kind of quintessential of a lot of deals we did during the post GFC market period. But there was a fund, we think an exceptionally strong manager that, like the example I gave before, had finished raising its fund in 2006 and put out a lot of its capital in 2006, 2007, early 2008. Not a great time, sort of peak of market when values fell. The fund had lost about more than half of its NAV. It had all the problems you could imagine it would have. Debt was in covenant breach. The tenants defaulted, so they were not only in covenant breach, but they were in payment default. There were loans maturing that couldn't be refinanced. There were construction projects they had underway where their construction financing went away. There was strong space with tenant demand that they couldn't lease because they didn't have liquidity for TIs to bring the tenants in. So again, I think this manager is a very good, smart manager. They developed a workout plan where they determined that they could recover about half of their lost value if they had, a big balance sheet capital to solve their issues with. So we worked with them, and we came up with a list of about 40 identified uses where they could draw our capital off a credit facility for each of these sort of predetermined uses. And it, worked as everybody intended. They ended up recovering substantial value from their fund. They used our capital to buy back their debt from lenders at discounts, thereby creating equity. They drew for TIs to lease up space, thereby creating equity. They used it to complete developments in lieu of construction financing, thereby creating equity. So they were able to really claw back a lot of their lost equity. If they hadn't had our recap facility, those assets would have just been gone. And, frankly, their fund and their franchise could have been gone. So again, it was a win-win-win. LPs won, we won, and the GP won.
Got it. That's interesting. When you talked about, you had a list of things that they could use the capital for, and that makes it very easy and very prescribed, but sometimes it's not so prescribed, and sometimes, situations have come up that you can't really predict. So what controls do you insist on? Will you only take a majority position? Will you only take a position where you have major decision right controls? Or have you sometimes gone in with less control and just relied on the real estate to work itself out, or the relationship, or just your basis being so good that you just figure, at that basis you can't lose?
Yeah, look, control is really important for us. It's sort of paramount to our business. We've used the control that we've negotiated countless times to not only drive stronger returns and realizations, but to solve problems. Again, with all due respect to managers, your interests aren't always aligned. So we've used the controls to, when we need to protect our interests. So we really do have a focus on control, which is very different than most secondaries investors or certain recap investors. And again, the controls, there's a spectrum of controls, and it can range from full absolute control with the ability to remove the manager at our discretion, which is very extreme, but we often negotiate that, especially if we have the majority of the equity in the deal, to a more lender-like control where we have springing controls that would kick in when certain covenants are breached or certain milestones aren't reached. Mm-hmm. And in the most kind of remote of cases, and this has only happened a couple times, where we've been brought into a deal, for a very small investment alongside a partner that's like us, that's on our side of the table, and we trust them, and we've done deals with them, and they've got all the control, and we've got the relationship, so we'll kind of ride their coattails. And again, we've done one or two deals like that with very small equity checks, but typically we're going for much larger control levels.
Well, to use bike terminology, when you're drafting, when it works, it's great. If it doesn't work, you probably change your policy. So. Yeah.
Well, that's why controls our policy.
Right.
So you have to protect your interests.
We've seen, typically this has really been a private market strategy, but there are certainly plenty of public companies today that are considering looking for private capital, particularly given the mismatch in pricing between some of the REIT market today and the private markets. Have you done anything with public companies? And I think, for example, pipes or public entities that you might have been able to help provide capital to, but with private money?
We have, yeah. We're a private markets investor, but we will do a PIPE, private investment in a public enterprise, for those that aren't familiar with the acronym. So it's really where you do like a preferred equity deal with a REIT or something. So we did a really interesting deal. It was a over-leveraged hotel REIT. It was thinly traded, over-leveraged. As you can imagine, it was getting pretty much hammered in the market, and analysts weren't really covering it because it was levered at about 80%. So we came in with a convertible preferred equity security, and the deal was if we hit, so we got paid current, we priced, we sized and priced it just based upon the real estate value. So the liquidation value would have been enough to get us our total return if things didn't work out. But we had agreed to convert to common equity if they hit certain milestones. And it included operational improvements, acquiring certain types of properties to kind of restructure the portfolio. And ultimately, it involved in a successful public equity raise at a certain price per share, so that would, ensconce the value. And if those events were hit, then we would automatically convert to common equity. And so the trick there was, you might ask, how could you be happy being, a common equity shareholder in a public company? Because it's not really a private markets business like you're in, and where's your control? We owned enough of it that once we converted, we effectively controlled the board. So we were able to, even after our preferred equity converted to common, we controlled the board. But the good news is they hit the milestones, they improved the company. When our equity converted, they effectively delevered to 50% LTV, and the stock price just shot up. So it was a win-win-win, as I said probably too often.
One of the questions that investors will ask us, and it's a hard question, I'm curious how you would answer it, is how can they get comfortable on a private situation where they don't have liquidity in selling their interest to you at a discount to what the GP says they're worth on an NAV basis? Because oftentimes it's at a discount to NAV. How would you help an investor get comfortable around that?
So clearly it has to be attractive to the investors, and they have to, consider potentially intangible reasons to sell at a discount, like they need the liquidity, or there's a portfolio construction issue they're addressing. But I'd answer it a couple ways. First of all, from a purely economic perspective, a recapitalization or a special situation secondary would allow them to achieve that liquidity immediately, as opposed to taking time. We only recap vehicles and funds, so there's always a high number of assets. Sometimes they're complicated, geographically and product type disparate. So literally liquidating those positions can take years, and taking a discount for an immediate liquidity solution can be really attractive to an LP, especially if they've been in the program for, as I said, like years or decades, and they've made multiples on their capital, really high returns, and they can leave a little something on the table for the next buyer, or they can allow the next buyer to take the value add initiatives and still have, had a great investment experience. So, again, efficient solution, quick, they can sidestep market risk because it's quicker. So that's a reason LPs typically choose to do it. But frankly, we're not the ones negotiating with the LPs. It's really left in the hands of the GPs.
Right. It just reminds me of that 80-20 rule, where you spend 80% of the board meeting talking about 20% of the portfolio. And,
right.
Clearly for investors who've been in the market for north of 10 years, and many have been in for 20 years, 30, and even 30, you probably have on their balance sheets old funds, which are very small dollar amounts, but they're just consistent sort of line items and probably discussion points. And at some, the materiality of just taking them off the plate too wouldn't be as great as just the nuisance factor of having them there. So
yeah, it can be that, or the opposite, where there's been a big investor that has been just invested in a program for a long time, and they've made so much capital that they're just ready to retire, liquidate, take their winnings, and move on. And we become the replacement investor going forward with the management team. Because a lot of what we do, again, are non-funds. They're not necessarily just funds with defined 10-year lives.
Right. So I'm going to ask you a couple of wrap-up questions. And meanwhile, if you are sitting in the audience, please feel free to throw in some of your questions in the Q&A tab down at the bottom of the screen. So Jeff, if you had to state the most important lesson learned from decades of doing these deals, what would you say?
Yeah, I think it's consistent with our mantra, which is don't buy anything that you can't diligence and that you don't have the proper level of controls over.
Diligence and control.
Diligence and control. You have to know what you're buying.
Right.
At a minimum.
Right. It's not roulette, that's for sure. And who would you say your most important teachers or influencers have been?
Yeah, that's a tough one. There's been a lot of them in my career. But just to make it simple, I'll go back to the very beginning of my career. There was one of my first bosses was a guy named David Dean at one of my first firms, Metric Realty, which was potentially the first institutional apartment investor based in California. We invested for CalPERS, CalSTRS, Alaska Permanent Funds, State of San Francisco, and we really, in the mid '80s, had really turned apartments into institutional asset class. And David Dean was the biggest stickler for diligence. He led our underwriting group, which I was a part of, and he was a absolute stickler for diligence. So, for example, when I'd go through a P&L as part of diligence, I'd add up 12 months of trash bills and make sure that they tied to the sanitary line item in a P&L. And when we were trying to figure out market supply demand issues, I'd go to sit down with the city planner and lay out a big zoning map and sort of say, okay, what's happening there and what's happening there, and when's this project going to come on? And then we color them all and mark them, and we'd spend a month and a half, 2 months on diligencing a single apartment building. And I think I learned from David there's no substitute for granular due diligence.
Well, I'll borrow from Ben Franklin, who said, diligence is the mother of good luck.
I didn't know Ben Franklin was in private equity real estate. That's, I guess it was in everything else.
He was a Renaissance man.
That's right.
All right. We're going to pop over to some of the audience questions now and just kind of run through them, and feel free to keep them coming. Are you seeing post-COVID deal flow pickup, and how do you see the opportunity set evolving over the next 24 months?
So we're definitely not seeing deal flow pickup relative to the pre-pandemic environment. There are transactions coming to market. There are stress points where recaps are needed. I think we saw it first of all in the CMBS and RMBS space, or with mortgage REITs, where their warehouse facilities, their repo facilities were margin called when their values dropped, and a lot of people moved in and recap those situations. But other than that, we're starting to see situations emerge. But frankly, there hasn't been, the market conditions haven't yet opened up for large amounts of volume. We need to see distress followed by capitulation by tenants, landlords, and lenders, and it's just too early for that. So, we're sort of sitting on our dry powder waiting for that to happen, and I think everybody believes it will happen with the undercutting of the general economy.
Hotels? Are you most excited about office buildings? Obviously, I mean, we've even seeing some industrial in the recap space, even though pricing has held up pretty well. what, if all those deals came across your desk at the same time and you had to allocate them to your team, would you say, hey, let's look at this hotel deal because it's probably likely to be the most distressed, or this industrial deal because it's probably likely to have the best growth opportunity? Or how would you think about it?
Yeah, it's really, look, I mean, we tend to be product type agnostic. I think we've done a great job of staying out of retail. We've made two retail investments in the last 12 years. So, and they've both been small and they've both been great. But other than that, we're pretty product type agnostic. We, underwrite, we do DCFs on all the properties, figure out, where we think, the value's going, where we think cash flows are, and then we'll either acquire the secondary interest on that basis or provide recap proceeds, on that basis. So I wouldn't say there's any one product type we're scared of, besides probably I continue to have a bit of an aversion to retail. Although I will say that I think that retail could be the winner in this market cycle, simply because there's going to be such a substantial weeding out between the winners and the losers. And I think we're going to probably be left with a healthy retail sector, because, kind of the walking dead are going to go away, and we'll be left with sort of a strong.
You heard it here first, guys. I haven't heard retail and winner in the same sentence in a while.
Yeah.
But clearly, yes, there'll be a strong weeding out, and those who survive will have a reason for surviving.
Right, and the retail that survives will be appropriate to address the way retail will be accessed going forward. And there's just been a lot of confusion about online commerce versus bricks and mortar ahead of that. So we think we're going to be left with a pretty healthy retail stock 5 years from now. So, but I didn't really answer your question, did I? I mean, we're somewhat product type agnostic. I think that there's going to be substantial opportunities, in hotels, because I think that people will continue to travel. I mean, travel may cut down for business because we'll be doing more of this and less flying to conferences and meetings, I think. But I think people will still go on vacation. People still will travel for business. Hotels are going to get hammered the most because a lot of them are at zero occupancy right now. You can't survive that. And they'll probably spring back pretty profoundly. But, we could probably spend a webinar on each product type discussing their, risks and merits. So.
Yeah. Wait, there's a couple of questions about what do product niches or property types that are operator intensive work better for recaps, because there's a motivation to keep the operator in place, like student housing, medical office. I mean, we've been involved in situations, for example, with managers who've wanted to recap a multifamily portfolio of really high quality assets, and the LPs have just said, well, sell it, please, because we think there's a much broader market and lots of people can manage multifamily. But that's not necessarily as true for some of these niche property types. But I think, do you find that in the 40 deals or so that you've done, they're more niche property types like the CARES portfolio that you talked about, or is that just a small factor in what makes for a good deal?
Yeah, I think it's a small factor. Trying to remember what exactly the allocation was, but I think something like 30% of our last fund was invested in multi on either secondaries or recaps, and a substantial amount of capital was in the senior space, in assisted living. So those were two, I guess assisted living is more operator intensive, to your point, but I hear the theory. I just wouldn't say that's our experience. We also did about 20-30% in industrial properties in our last fund, and high yield recap and special sit secondaries investments. So again, that wouldn't seem to apply to your rule, but I think the rule has merit. It just hasn't been our experience.
Right, that's fair enough. So there's a bunch of questions here about pricing discounts. I'll just read it, see how we can answer it. What kind of pricing discounts do you look for? And is it typically based on a percentage of NAV or GAV, net asset value or gross asset value?
I mean, look, I mean, we think, so my background is in direct investing, and I've always, for 20 of my 30 years, I've been focused on just buying opportunistic and value add real estate. And when I entered the secondary space and, was intrigued by it and started working in the secondary space, the whole concept of discounts it didn't compute for me. I didn't understand it. I couldn't wrap my head around it. Discount to what? And why does that matter? Discount to some manager's view of value, discount to some appraiser's view of value. I have no idea what that means. I'd grown up doing detailed underwriting on assets and making conservative projections about future cash flows, and then applying the discount rate you needed to make your return, and that's what you pay. And that's what we still do at StepStone. We don't think about discounts. The discount falls out of our DCF. So we come up with the price we need, and whether that's, 10% or 30%, that's what we'll pay. So I don't really focus on discounts as much as I focus on target returns using appropriate and conservative underwriting. I can talk generally about the market. I think for traditional secondaries, the market had been around 5 to 10% discount off of NAV because it got really competitive. Our discounts have tended to kind of range from 15 to 20% typically, but again, the widest being like 30 and the smallest being like maybe 5. But we think that maybe that 5 is because the asset wasn't marked correctly. So again, discounts not being the big factor for us.
Got it. Well, I think, we probably deal with that question more because as a bridge between the investors and the GPs, the investors are very concerned about whether or not there's a discount, and the GPs as a fiduciary are very concerned about whether this is the right execution. And so, that's really where it comes up. You're really coming in as a buyer and saying, here's our offer, take it or not.
I agree, but I'll tell you, a substantial number of secondaries buyers in the market do focus on discount, and because they're, again, when you're doing traditional secondaries, you're looking at a top-down approach, and it's very hard to do the bottom-up, deep granular diligence on the asset. So you're playing with really 30,000-foot models and looking at impacts with different discounts. So it's more of a discount-oriented pricing than a bottom-up DCF-oriented pricing. So a lot of the buyer market does focus on discounts.
Got it. There's a lot of questions about how do you source recaps? Do they just fall into your lap? Do you just take all of our phone calls and we bring them to you? Tell us a little bit about how you source these, and other than Park Madison, where you find these deals.
Absolutely, just Park Madison so far, at least the good ones. Yeah, absolutely, Nancy. Intermediaries like Park Madison are absolutely important, and I think I think firms like yours that raise capital and that are really close to so many GPs and operators trying to be GPs. Groups like yours that an operator may come to them wanting to raise a fund, and you say, probably not ready yet, but talk to StepStone because you've got an interesting portfolio, and there may be a recap opportunity here where you can kind of get your feet on the ground. So we do source quite a bit through intermediaries like Park Madison, but actually the substantial number of our investments have just been sourced directly. It's one of the big advantages of being, a significant advisor in the industry. We meet with every GP and every operator on a regular basis to underwrite their funds, to get information in their database, to look at them on behalf of our LP clients. Last year, we put out $13 billion into primary investments in the market, and in so doing, we held over 750 meetings with managers, and each one of those meetings is a sourcing opportunity. So So we absolutely source recaps and secondaries from those channels, from those meetings, as we're constantly meeting with managers. And look, we're known in the market, and so a lot comes in over the transom. A lot of people call us, and that's really so intermediaries. Our advisory service practice brings in quite a bit, and just general knowledge of the market, things come our way.
Right. And that's really how we got into the business. Is we would look, at the end of the year, and if we had looked at 150 real estate opportunities, managers, operators, developers, and only maybe 3 or 4 really were fund ready, fund worthy. There's this huge supply of real estate out there that doesn't fit into the fund format, and would certainly make sense for, some of it would make sense for someone like you.
There's a lot of investments we've made that have been catalyzed by that factor.
So I'm just going to try to summarize and then thank everybody again for joining us. There's so many motivations for pursuing a recap. Investors, may need liquidity. They need to rebalance portfolios. They want to seek an exit, but it's accretive to the value to have the sponsor stay on with the assets. And for GPs, they may have partners a partner who wants to exit a portfolio and they don't want to sell. They need capital. The fund may be at the end of their life and there's a timing mismatch. They may need they may need to do a debt recapitalization, leads to an equity shortfall. They may want to consolidate their investor base for scale and growth, reset a business plan with fresh equity capital, all kinds of structural complexities that make an outright sale less attractive. And for investors like StepStone and others, having pre-specified assets, often large-scale portfolios, mitigating the J-curve. The J-curve meaning you're immediately invested. There's not a commitment period. And obviously the opportunity to invest directly with a reputable sponsor. All good reasons to pursue a recap. So I think we'll see a lot more of this in the years ahead. We know we'll see, Jeff, a lot more from you and from StepStone, with the capital that you've amassed and the business that you have and the really strong team that you have. And so I thank you very much for joining us today and hopefully shedding a little light on the world of recaps and secondaries.
Great. Thank you, Nancy. Really, really enjoyed the conversation. I want to thank Jeff Dorman and IREI again for sponsoring this and letting us have this conversation. So thanks, everyone.
Great. Take care.